where'd you come from? Are you born and raised here? Was the family in the business? Give me
Sure.
more. Tell me your story.
Nope. Family was not in real estate. Mom is a restaurateur. Dad was in the manufacturing business. Uh, After college, I went into real estate because in Los Angeles, either you become a doctor, a lawyer, or you go into real estate. So I wasn't
Yeah,
the
a little
wasn't
bit.
becoming-
Right.
right, and yeah, not becoming an actor or anything of that sort. So real estate by default was the only profession left for me to pursue. So I did that. Graduated in '07. So pretty perfect timing coming right into the crash. Um,
Yeah.
worked at a small boutique investment shop for about 2 years doing high end retail. I wound up leaving that job after basically right capital markets tanked. I watched 5 seasons of The Office at work in a period of 5 days. And when I got through all 5 seasons of The Office and there was nothing left to watch, I realized that's probably not a good career path to just be staying at a job where I'm just watching Netflix. So I started looking around for some opportunities, wanted to travel as well. And I landed a job with KPMG in Israel, where I was working in their valuation and advisory business. Worked in Tel Aviv, Israel for about 3 years. At the end of those 3 years, I kind of was looking for um, kind of the next thing to do. And an opportunity was presented to me to come work at a small investment shop, real estate investment shop back in LA. And I took that opportunity, came back home, and we wound up raising a small closed end fund and basically invested through that vehicle for about 5 years from 2013 ish through 2018. Um, and so I kind of helped co-manage that fund. And I mean, we did a variety of different. We pursued I mean, we were more opportunistic in what we went after, but
Mhm.
just kind of we our portfolio kind of gravitated more towards value add multifamily. So we're doing just a lot in kind of like the workforce space, buying a lot of rent control properties and fixing them up, flipping out of them. We did some ground up as well, but kind of touched all things real estate. But I'd say multifamily was really where we were primarily focused on, not for any other reason other than just that was where the opportunity was. So, you know, that kind of led me ultimately to at the end of 2018, we closed out the fund. Um, Left, started my own thing, and kind of been doing that for the last 7-ish years. Focused on primarily multifamily, which kind of touches different areas in the space, but that's pretty much how I got to where I am today.
So let's go back because again, so much of and the so much of the story of today has a lot to do with what yesterday was.
Mhm.
And I'm reminded of when we met. That was it sounds like that was your old partner who you guys had that building on La Brea that was next to the one that I think investment group that I worked with. Is it? Do you guys still own that one? Is it, you know what I'm talking about
It's
on
you're,
that
you're
one?
frozen.
That's so strange because I'm getting the same problem on your side. So it's the clarity is a little bit funky. Can you hear me now?
Yeah. Can you repeat the question?
Okay. Yeah. So much of what is happening today is it's important to understand what was happening yesterday. So let's go back to 2013, and let's talk and touch a little bit about you and your partner getting into multifamily. Tell the story of what was the environment? Why were you looking at that space? Um,
Sure.
and what was the state of the market back then?
Oh, I don't like to think about it because it's just it was it's like looking back at like is like being in a dream back in those days when you're investing. So when we were looking at multifamily, really any opportunity. First of all, real estate was not what it is today, right? Back then, in particular in Los Angeles, it was largely just dominated by smaller players, family offices, rich individuals that we're buying and selling real estate. It really was not a well established asset class where you had a ton of institutional money coming in and it being, just so highly saturated as it is today. So, when we were buying back in 2013, first of all, rates were, wherever we were borrowing at the time, maybe 3.25%, right?
It
And
was fantastic. Right.
right. And then on top of that, given where real estate was at, that it's would just started kind of coming out of, its recession. I mean, we were buying pretty prime real estate in terms of area, still buying older product, but buying pretty prime real estate at 7+ caps. Right.
Right.
So you're buying 7+ caps, you're borrowing at low 3%. I mean, we were underwriting deals where we are generating out the gates without doing anything to the property, mid-teen IRRs, mid-teen cash on cash return,
Cash on cash returns.
right? Just out the
Right.
gate. You didn't need to do anything. So just on cash flow alone, your deals were hitting mid-teen IRRs. And then
Right.
you layer in a little bit of appreciation, you're hitting a 20 eyes closed, right? And the crazy thing was that when you're looking at deals back then at those types of returns, they didn't seem fantastic. It was like, okay, I'm getting a 15-16% cash on cash. Seems decent. Let's roll the dice. We'll buy it. We'll buy this Los Feliz beautifully. Great asset, good rents. Um, and so, everything back then was just priced on in-place cap rates. This whole concept of, buying things on future value, on future rents was really not a thing. And, that's where I credit my partner and I for kind of looking, um, kind of, iterating on that and saying, all right, well, if tenants are paying $900 for a two-bed, we see down the street, they're getting 1,500 for a two bed. It's like, well, there's clearly some upside here. The question is, how do you go about getting that? And, we started doing some cash for keys. And I can tell you back then, cash for keys was not a thing. Like, it was not on anybody's radar. It was not on the housing authority. It wasn't on anybody. And, you go in, you talk with the tenant, you tell them what you're doing. We're renovating. We're giving you an opportunity to move out. Here's some cash. And within 24 hours, you'd have a deal and the tenant would move out in a few days and you get your unit back and you take your rents from 900 to 1,500. So you can only imagine what it was doing, right? And also it was, we're also investing into a period where rent growth really started to tick up over the years, right? So
Right.
not only being a beneficiary of interest rates being unbelievably low and already buying at unbelievably strong cap rates, but then you got the added benefit of the fact that rent growth really started to tick up, and then layer in on top of that cap rate compression, right? I mean, all the
Yeah.
markets that we're buying in, if we're buying in Highland Park at like an 8 cap, and again at the time it was like, is this a good deal or not? You're buying at
Right.
85 out the door, and you're just like kind of scratching your head, like, okay, what am I missing? But we were aggressive and we were pursuing these opportunities. But I mean, it was just insanity because you'd go, you buy something at a 7.5 cap. One of our first deals we bought was off was in Silver Lake, like a very nicely renovated 8-unit building. And, within 6 months, we flipped it. We bought it at a 7.5 cap and we flipped it at a 6 cap, and it's just like, wow, this is a great space to be in. And cap rates just kept going down and down and down. Um, and
Yep.
and it, it
Yep.
it still made sense because even if we were buying a 5 cap, you were still borrowing low 3%. And banks were giving IO and you were getting solid leverage at 75%. So, all those factors, it just made it, an unbelievable, like very enticing value proposition, to be buying these types of assets. And again, everything was being priced on in-place income. Like that was just like how it was done. No, like
Right.
no one, you talk to you talk to another real estate investor, and then you would tell them, hey, you know, there's this opportunity here to take rents from 900 to 1500, for instance, right? And like, well, how are you going to go do that? It's like, oh, we're going to pay the tenant to leave. And like, they're just scratching their head, being like, who the hell pays people to leave their buildings?
Right, right, right.
Counterintuitive to the whole purpose of real estate, which is just good, steady, stable income, right? And so, like, us and a couple other firms are really the first guys to kind of see this opportunity in the marketplace. So it made buying real estate just, in particular, multifamily in LA, just extremely lucrative. Since no one was really pursuing it, banks didn't understand it. We had a Chinese bank that thankfully was willing to provide buyout monies, kind of as to treat it
Right.
like tax
Yeah.
dollars, right? So, you layer all that in, and all of a sudden, hitting a 50 IRR was like pretty commonplace. It's just like it really didn't take much,
Wow,
which is
there
weird
you
thing.
go.
Where
Right.
the we were just and we were lucky enough that we had a great investor behind us that was you know gave us our start, and so we were flush with capital, at least relatively speaking, for the time. Like back in 2013, 14, people weren't doing non-contingent, going hard on $500,000, or even, putting up $10 million all cash to buy real estate. Like that just wasn't the marketplace. And if there were, it was guys far and few in between, and who just, again, real estate was like a secondary thing that they did. There wasn't like guys like us coming in who, would pursue these opportunities extremely aggressive. So for the fact that, one, we had conviction, two, we had capital behind us, it just gave us an insane competitive edge over everybody else, right? I mean, we were doing like 2 deals a month for years. It was
Right.
crazy, right? So, like that's what it looked like back in 2012, 13, 14, 15 for us, where it's just, I mean, we couldn't buy this stuff quickly enough. Um,
Right.
so yeah, I mean, that's, I get depressed talking about it out loud, but that was the
Yeah.
landscape.
It's interesting to hear your take on this situation was during those years, and I have to confess, it lines up pretty close to where my experience was coming in, working through the market cycle previous, and then coming through that trough, that low interest rate environment. The pricing had really come down. The buyer pool had thinned significantly, and you are correct that, you and a couple there was this thing that happened in coming out of the Great Recession, where, you've got a new generation of investors, and I will add that there was this element of young people who had, had family office money or wherever they had kinda come from, but they had a little bit of a Wall Street approach to it. So there was a fair number of guys that had came to the market like yourself, that had that approached it like a private equity company, and that was what was
Mhm.
different. Like, you guys came to the table and you look at it like a private equity deal. And the mom and pops that I've worked with in the previous years, they still ran it like a business, but you're correct. They didn't run the math on the buyout calculations the way that you guys did. There was a couple of other shops that came to town that were doing it, but it was a totally different business model to look at that and say, you know, "Look, we're gonna take this business from here to here, and we don't care what the costs, whether you're putting in a kitchen or you're removing an older tenant and you're sending them on their way with some motivation dollars, that the total valuation and the rate of return is gonna be better with that new kitchen and with that tenant being replaced." And you're right. The older generation were shaking their heads when I said, "Hey, have you ever contemplated, just writing a check to the tenant, letting them go?" They're like, "Yeah, why would you do that?"
Yeah.
So So that's really interesting to sort of see how, that was real life for you. That all that stuff was really happening, and clearly, you sound like you bought a lot of deals. Did you hold on to all of them, or did you rotate them all? What was the fate of
Um,
all that business?
we were. I mean, given that we were in a closed end fund, eventually we were, we exited out of everything. But,
Eh,
um, you know, at the end of the day, um, it was just hard, right? Because I mean, you buy something at, you know, let's just say you bought something at a 7 cap. In a couple of months, that 7 cap is now, that 7 cap deal's a 5 cap deal,
right,
or a 4.5 cap. It's pretty hard to, to say, sure, I'm just gonna hold on to this asset, even though I can literally like triple my money, inside of in 1 year or a year and a half. You're just kind of like,
right.
oh, as much as we would, of course, hindsight, I would have loved to held a number of these assets, but at the time, it was just as the market started picking up, more people got into the space. Um, it just if you had the ability to move quickly on deals, you could buy them at just such unbelievable valuations. Um, that the spread to be had it was enormous. It was just like it was kind of hard just to say no to it and just kind of ride out the market and hold on to these assets. So, we for the most part, I mean, eventually we were going to have to exit out of it just by virtue of being in a closed end fund. But I mean, we were, at some points literally buying properties and relisting them the next day and taking a 10-15% spread on them. Right? That was not an uncommon thing.
Right.
Um, Granted, I would say
Yeah, it was quite a run.
that we
It
were
was a
good at
it was a quite a run, and it was all
value. Say that again?
I just was saying it was really quite a run. It's if you map out where interest rates were and where gross rent multipliers were, essentially coming out of 2011, 12, we were in like 3.5% interest rate environment, and that stayed until very recently. I mean, for the most part, the interest rate environment didn't change until about 21.
Yeah, no, I want to say, I mean, what it was. Well, I'd say it went right like 2018, 19 or so is when like you started to see rates starting to tick
Right.
up, right?
Sure.
And like starting in 2015, I can recall, talking with a variety of different finance guys, business people. Everyone's like, oh, we're due for a recession, right? It's just like, okay, we're gonna have a recession in 2017, 2018. It's like every another year
Right.
goes by, it's like, oh, the market's still rock solid. Um,
Yep.
2019 rates started ticking up a little bit, right?
Right.
But then you had the pandemic, right? And then it was just like, oh, back to free money. And then, we are where we are today. Um, but yeah, I mean, just a whole number of factors from 2000, at least from my perspective, when I got into it from 2012,
Right.
through 2016 ish is where it was just kind of like, all right, let's go hard, let's get super aggressive on these deals. Then I would say starting in like 2016, 17, again, it started to feel frothy, at least to me. Where it's, well, how long can this continue on for? Like, we can't keep rates here
Yeah, I would
forever. And
say
it
there's
was
the
starting
same
to
thing
feel like
because
something
around that time it was
which,
the market.
nothing intimately did. But the when with the rates, again, like as rates started ticking up, there was some, you started to see some adjustment in pricing, but not quite. Um, and I mean, obviously, for at least for me, like, volume really started to slow down just because I wasn't quite seeing the, where the opportunities are, given that rates were rising and valuations were still kind of holding steady based on this, like, 3% interest rate environment, and the only way to, continue to drive real value is you needed to see, either a serious uptick in rents
Yep.
or you needed more cap rate compression. Which again, like that, like it wouldn't make any sense to see unless you're buying it at such a steep discount. But there was nothing really to create real distress where you're buying it at a discount, unless you can kind of sniper some deals here and there. So anyway, it was, yeah, I would say, it was a good, for us at least, good four-ish years of just an incredible bull market, that really
Right.
rewarded people who went, who were super aggressive. And then, from that point on, where it was kind of like, all right, let's sit back and reevaluate what's happening.
That's cool. And um, the thought that I had for you on that one was that the God, actually, I don't even know what the thought was, but I had one at one point. So let's take this to the how the market changed. So interest rates go up, and we're in COVID now, right? And then interest rates start ticking up, and then what outside of those factors. Oh, I know, I remember what it was. It was, if you look back on those years as well, and this is that you'd touched on it, but rent growth was at better than 7% a year, and sometimes it was better than 10% a year. And so that cycle was, pretty meaningful. A one bedroom at the beginning of that market cycle on the west side, a one bedroom was going for like $1,500 a month, 1,250 a month. And by the end of that cycle, we were looking at $2,500, and I had clients that were renting renovated units for $3,000. So we're talking about rents basically almost doubled.
Yeah, and that was
What's your
it was
experience?
crazy. I mean, yeah, I mean, whatever you underwrote into your pro forma, right? By the time you got your unit and finished renovating, like you were 10-15% above whatever your pro forma was, like, within the 6-month period. It was crazy. I mean, you just, again, I'm gonna say there is an element here of being good operators, good investors, good execution, like, being able to execute on your business plan. But the amount of beta, just the wind at our backs for every operator, any investor who wants to tell you, "Oh, look at me, I'm a genius that invested in that period," is
Right.
just, is fooling themselves into thinking that they're, you know, that they're as good as they are. Like
They're
you,
a fa they're like, "You don't know what a fast runner I am." And I'm like, but I know that you're on a 10% slope right now, so there's a little bit of favoritism to your track time
way
right
more
now."
than 10%. This was just a free fall, like in good sense, right? It's like there was one strategy. There's one strategy that if you employed from 2012 to 16, if you employed it, you were virtually guaranteed to make money unless you just were, you bought some. I don't know. You fell off the face of this earth. But if you did one
Right.
thing and one thing alone during that time period, you made a lot of money, and that was buy. If you bought, you made money,
If you
like,
buy, you
period, and, like, everybody who wants to, you talk to people and you hear their pitches, of course, everyone's gotta tout their, all their strengths and what they can do, but it's like, no, you look back on that time, I'm like, when was there an opportunity that you could buy something with like a 4 to 500 basis point spread between your going in cap, your cost of debt, you got good leverage, you're buying into a market where cap rates were moving down, rent growth was just, skyrocketing. It didn't matter how, like, there was no mistake you can make in your deals
right,
that could make it go underwater. Like you had to be proactive to screw up your deal,
right.
right? Like that's how insane the market was for during that time, and that, I mean, that carried through for a while, and then that obviously coming into the pandemic, once the pandemic hit, the first couple months of the pandemic, they brought rates down to zero. Basically, I think the Fed funds was at zero or whatever, wherever it was at. Rate
Right.
came down. Everyone, like, you know, buying was on hold. We bought an asset during that time. It was scary as hell. But then kind of like into late 2020, it was the same deal. Just like rather than kind of like urban cores like in LA or San Francisco, you all of had the suburban markets really just
Hmm.
explode. And again, there's a number of syndicators out there, won't name names, that's like they bought in the right areas. They bought in markets that were, trading at one point 6, 7 caps. I mean, I remember buying, I started to look in Phoenix, like 2018, 19. I started looking outside
Right.
of Los Angeles just because, I was looking for more yield. And I started
Right.
looking in Phoenix and other parts of Arizona. And, at the time, those markets were like 6 plus caps, 7 plus caps for, whatever your 60s, 70s, 80s product. Um,
Right.
Fast forward to late 2020, 21, those same deals, which you bought at a 6.5 cap, didn't do a thing. You turned around and flipped them at a 3.5 cap. For what reason? I
What?
have no idea. I have no idea how that much cap rate, but that's what started happening. You had, Vegas, markets in Arizona, Denver. Oh, I mean, yeah, I would say Denver. Denver already was like kind of on the up and up, but
So
kind of these boom and bust markets that historically would get rocked during downturns, all of a sudden
right.
just exploded. Um, Again, if you just
So
bought in 2020 on one, you crushed it.
that's a really interesting question. For I have a question for you. Is is watching a market like that, is that a late stage indicator? I mean, should that be the, like, canary in the coal mine? When you see, like, major metropolitan Los Angeles, right? And Los Angeles kind of tops out, and then you get these frothy, markets that are near to them that are growth markets that then get this sort of buzz effect. Because the same thing happened in the
I mean,
in the mortgage meltdown in
the short answer is
2007, 2008.
yeah.
Is that is that should have that have been a huge signal that the world was about to come to a big change when you see a market like Phoenix all of a sudden start seeing the exuberance that was tapped out of Los Angeles?
Yeah, look, again, I mean, I didn't buy anything in those markets at those cap rates because it didn't feel. I just
No, that
I didn't see the value, right? So, but I mean, it was across the board. Everything just felt way overvalued. I think though, what you're seeing now, right? Ultimately, like boom and busts are a function, I think, of, right, like what happens in, with your debt loads, right? So in theory, if you bought a 3.5 cap all cash, then like there's really no issue of you going underwater, right? It's just a matter of maybe you may not make as much income. um so there, people were borrowing unbelievably high levels of debt at super low cost, right? And then, I mean, the question just became like, okay, well, where can you stabilize to, right? Can you stabilize at a cap rate that would feel reasonable enough that if rates do rise, can you still refinance out your existing debt? So there's that element, right? Of like what your capital stack looks like to in terms of it becoming posing an issue or not. Then the other thing, which is this like the basic, it's like laws of physics. This is just like supply and demand, right? So it's in theory, if you have just tons of people moving into an area, maybe buying a 3.5 cap does make sense because you just have so much demand out there that you can kind of what a lot of people were expecting, 5% rent growth in perpetuity, right? Whereas historically, you're kind of underwriting, let's say, anywhere between 2.5 to 3.5. People started to say, well, there is a fundamental shift happening in America, right? So that aspect of it, I think, is a little bit further
fundamental
just like
shift.
yeah, I
Hey,
think I
that
think
that's a those are canary in the coal mine stories. If you talk to any old investor, when the young guy goes, "There's a fundamental shift happening," they go, "There's a shift happening for you."
but you're seeing it, right? Like there's a legit out migration, right? There's a legit out migration to states like Texas and Florida, right? Out migration from like your Californias, your Chicago, your New Yorks, now going to other states, and I think that it's here to stay. And you're seeing companies moving headquarters. It's not to say that markets like LA, San Francisco, you name it, are necessarily dead, but I mean, I think there is a real like there's a secular shift where people are living in America that, what were once considered tertiary or secondary markets are now becoming primary markets. Like that I do believe is happening. At what scale, that's time will tell.
That's a perfect segue for the kind of what's happening here in Los Angeles. So so let's fast forward now. So the market shifts, so on and so forth. What's happening in Los Angeles now? And you know, tell us a little bit about, because when I'm wearing my broker hat and I'm calling you and we're talking about deals here right now, what's different about your calculus today? And talk to us a little bit about that.
Um, so look, I think fundamentally speaking, from like a supply demand, LA is still a very attractive market, right? It's unbelievably hard to build in. Um, all the regulations and laws that still exist, you know, still make it very difficult to bring new product online.
Yep.
And again, like I largely focus more call it like the class B and C space,
Right.
where we're still providing some level of affordability. Um, even, I haven't checked like the census, but LA is just so unbelievably dense. Like your demand's there. It's just kind of a question of like, okay, is someone gonna rent out your one bedroom at 2,100, or is it gonna be 1950 or 2,250? Right? You're just that car takes some art to it, but like you know you've got renters for your building. So from that perspective, I still think like Los Angeles pose is still um fundamentally sound to be, to be buying in from that from that perspective. However, the biggest issue, which everyone complains about, is just the regulatory environment, right? It's unbelievably costly to do business here. And the hardest thing about about Los Angeles or California for that matter is you really can't underwrite regulatory risk. You just right because it's almost like a zero sum game. Because if our legislators decide to come out with some law that completely prevents us from being able to raise rents, like, well, then you're going to see you know what happened in New York with their whole rent stabilization. I think it passed in 2019 that effectively created vacancy control. If that happens here, like, your assets done, it's literally worth zero. Like, I mean, not worth zero, but these assets that maybe you're at, like, you're operating at like a 6%, 6.5% yield, now becomes, someone will buy it from you for less than 8.5, 9, because there is no opportunity to raise rents. Right. So there's always that in the back of our minds whenever we're buying here, is like, that they'll create, that's more of like something where either you are saying, I'm not investing in California or LA for that matter, or it's like, fine, I'm going to run the risk and we'll see how it goes. But, um, as far as how we're looking at Los Angeles, it's tough right now because you have, even some good solid assets like the ones that, we're looking at, and, by La Cienega and all that, right? It's like, okay, good buildings, good unit mix, good area. Um, but the question just becomes like, all right, how are you gonna first of all achieve, how are you gonna achieve your pro forma? Right. I can tell you, like, offering a tenant, buyout money is a complete crapshoot these days. You can offer, you can offer six figures, and I'm telling you now, I know firsthand, like, they'll tell you, get out of my apartment. That's not good enough. Right.
Right.
I'm not saying that's across the board, but that's like what you're up against. Right. So, like, at least from our perspective, I mean, look, we're not buying a lot, and we're buying very, very selectively. It's hard to get excited about buying a 5.5 cap when I gotta go borrow at a low 6 cap, So you've got negative leverage, out the gate. You don't have any clear path as to how you're gonna increase rents. Costs are just skyrocketing. Insurance, you're getting rocked on. Utility bills, you're getting rocked on. Um, labor's hard to find.
Let me ask
So,
you this.
you when you're looking at your income statement, you have a ton of uncertainty around revenue, and then you just see a straight upward slope on your expenses going up, and you're borrowing at your rate is higher than what your cap rate's at. Like I just it's very hard to say to see where
to
the
make
value.
to make that all pencil. So
Yeah.
let's back this up a little bit, and you and I, we can talk and we can throw out a lot of vernacular and I can understand what you're saying. But let's just say there's somebody in the audience right now, like on the, is listening to something like this. And they say, okay, regulatory, issues, you know, to protect the tenants. Let's, I'm going to take a slightly different perspective on this. And I'm going to say, okay, well, but, you know, don't explain to me how, because in one scenario, we started with those podcasts about how the real estate investor making great returns, so on and so forth. So let's flip this around a little bit and try and I'd like you to sort of explain how the the what that regulatory environment really explain what that is. And let's kind of like let's hash out a little bit about why those things are become so burdensome and can get in the way of the desire to even want to purchase the real estate. Because again, we're in an environment, I think, politically right now where the landlords are looked at as um, just focused on their returns, and candidly, they're investors, so they should be primarily investing, looking at their returns, but they are providing housing. And so, from the standpoint of trying to create this sort of like balanced understanding of the providing housing and a return, what are the problems with the regulatory environment today that get in the way of being able to provide housing to the people that pay rent, right? And these are presumptions here that we want to provide housing to people who are going to actually also pay the rent. What do we need to do in order to do that? And what are the problems right now with the regulatory environment?
So, look, you need some sort of framework to ensure that, you know, if there's bad actors from the landlord side, that there's ways to penalize them. So um it's not like all regulations bad, right? Like you need rules
Correct.
to
Right.
set to set an even playing field. Um,
Exactly.
I think that, and I want to be delicate with how.
Oh, I know. I'm posing some sort of some challenging questions here, but I kind of think it's interesting to to frame that a little bit. So, for example, like, just for the record, let's answer this question: is rent control bad?
Um, so look, there's been tons of studies on it, and when we say bad, when we are like, are we saying bad in terms of bringing on new development? Are we saying bad in terms of reducing capital inflow into communities and ensuring that the housing stock stays well maintained? Right there's this is a highly um contested point. I would,
Right.
by and large, say that rent control does more damage, and I mean that's already been well documented by, I want to say, Berkeley's done their fair share of studies. I think Stanford has a study on this. UCLA does studies. Harvard. The bottom, like what rent control does is, one, it definitely reduces the investment into the, a city's housing stock, right? Like there's absolutely no reason to invest money into a building if you're not going to see a return on it, right? Like that's just pretty straightforward.
So what you're saying is that the interior of the units or the exterior of the units will not get the same level of care because the rental income that's being generated is won't be commensurate with the investment.
Well, you
Is that
can't
essentially
even
what?
necessarily increase your rents, right? At least
Right.
again for a rent controlled building. Um, so yeah, right. Like there is no incentive there to be spending money, right? So you will start to see over time your housing stock deteriorate, and of course you don't want to see people be displaced, but on some level, it's kind of hard to justify to a landlord. It's like, well, go spend $20,000 fixing this person's unit who's paying you $500 a month, right? Like, it's not a reasonable ask. So what's going to happen is that landlords are going to kind of do the bare minimum to ensure that that house can pass a housing inspection, that unit can pass a housing inspection, and that's what it is. You know, rent control further it limits mobility, right? Because you just kind of get stuck where it's like, okay, it's like I'm paying such low rent, I don't want to move, so you get very little turnover, and so, like, kind of the next generation that wants to come in and you want to give them new housing, they're kind of locked out.
Yeah, I think that that's a point that is not is missed a lot, is that you have this housing shortage, and when you create rent-controlled housing like this, and that locks in a lot of your population, and some of that population, in a sense, the landlord ends up subsidizing the person who's a very has a very low level of productivity, and they're able to stay in that low level of productivity, which does have an effect on the entire community. I mean, that party is, whether they're driving around, whatever work that they're doing might be less than optimized, and they have not had to make the same decisions, talking to their boss, saying, "I need to make more money," realizing that the economy doesn't fit them anymore. Maybe they're more well suited to relocate necessarily to, an outskirt of the Los Angeles region, or maybe they need to go to Phoenix or whatever. And
Yes and no. On that point, I will say, look, it's unbelievably important that cities have housing stock that caters to, call it, like, low income and middle income earners, right? Like they're doing a lot of the jobs, let's just say that, you know, um, let's say higher income earners, they're not going to do, right? So you need that in order to kind of support the economy. So it is important
it's
on some
huge.
level to ensure that your housing stock, covers kind of the full gamut of the income stream of income earners, right? So like that I will
Because
say,
you don't have
yeah. Sorry.
No, it was always I was it always seems like it's a hard dynamic trying to balance, and I'm sure the city has to deal with this. It's a hard balance trying to figure out how to, you know, I make everything move and stay in balance, like, dynamic.
So, yeah, right.
Right.
Things are constantly changing. The demographics change from maybe a younger crowd to an older crowd. What does that mean? You need senior housing. You maybe have more college grads coming in, so they don't have as much disposable income, and you got to cater to them. Um, so look, it's right, like economies, cities, everything. It's dynamic. It's constantly changing, right? Um, and so the hope is that your laws and everything should have a degree of flexibility in them to kind of cater to what's happening in your economy and what you're ultimately trying to achieve. Sure, rent control, for instance, is just kind of like the main topic. Um, it does ensure housing for, some of the most, at-risk population, right? Like,
Right.
you can't if, someone can only afford the $900 a month, and like that's what they're, that's what they have, it does ensure that they can keep their housing and someone's not going to come in and necessarily, take their rent from 900 to 3,000. Right? So like
Right.
there is some virtue in that, right? But that gets at the bigger issue is, well, we need to be building more, right? And just
And how
kind of
you end up
creating
building.
laws. Yeah, right. How do you go? So it's like, okay, which, we're, the state, on a state level, on a local level, we're trying all these various things, ED1, or, giving density bonuses and a variety of things. But again, I mean, Los Angeles, again, is just, there's not a ton of land. Um,
Right.
there's,
Trying to regulate the growth in a way that it's like they're deregulating their own regulation in order to try and create the growth. And it's an interesting dynamic to be like, well, didn't you make the rule in the first place that then the new one is trying to undo the rules that you made to make it difficult in the first place? If you didn't have the first rules, you wouldn't have to create the second rule that undoes the first sets of rules. You could, if you just, did a little bulldozing, you might find that the market, flows a little more efficiently than the prescribed version.
yeah,
All
sure.
right, so we can agree that just some. So yeah, the talk there. I was going to say we can agree that some level of rent control or some type of regulation is there are some benefits to it, and then there's a but. So tell me a little bit about, because one of the big things that has changed since COVID is the level of tenant protections that have come into place in terms of related to evictions and just cause, and how that goes through. So how is that playing a role in what you're doing in your decisions right now?
It's at least in Los Angeles, I think, most of the kind of the COVID related regulations have expired. Uh,
Mhm.
but just kind of on that point, right? I just think it's 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 lazy to just penalize like one once one group of an industry, for instance, like the real estate industry, and just to say you guys are responsible for figuring out affordability, but we're going to tie your hands behind your back. But we still are going to rely on you to ensure that we can provide affordability, right? So meaning it's like no rent increases were allowed, no evictions were allowed, right? And obviously that then starts creating perverse
Right.
incentives for tenants, right, to behave a certain way. And then I can tell you, we have, a few $1 million of uncollected rent, not to mention
That's a lot of money.
there was no relief that we got as it relates to utilities. Like we still were required to have to make sure that the buildings run perfectly well
Right.
while begging tenants to pay us rent, right?
Yeah. Yeah.
Um and so like just that, like it's just lazy to me to just go after, right, like one group and say, well, you're responsible for making sure these people's livelihoods are going to be okay.
Right.
Um, and so, whatever, we dealt with it. It's in the rear view mirror. There's still obviously some, some pain we're feeling from it, but, it was, it's frustrating because, right, you're on one hand, the group that you're penalizing is the same group that you're counting on to solve the issue. And
Yeah.
it's just not, it doesn't make much sense to me because I find, and again, I'm not big enough to necessarily be called to the table here, but
Right.
you would think that, hey, if we have a housing issue, who would be the first person you would want at the table to try to figure out a solution? It would be a housing provider,
The housing
right?
providers, right.
It'd be like, let's go to the people that we are counting on to do the thing that we need, which is more housing, as opposed to, well, no, 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 no. They have the wrong incentives. They're the ones that are just trying to make a quick buck. So let's leave them out of the
Yeah.
conversation because they're only going to be looking at it through one lens, and we'll just have we know best kind of thing. Right. So
Right.
like that's where I get a little bit frustrated. And not saying that I need to be there at the table. But it doesn't really add up for me how how kind of sometimes the policies get set, right? I mean, yeah, again, just kind of expanding on this a little bit, like take ULA.
Tell you what, Eli Lilly?
ULA.
ULA, yes. Yeah.
Right. Like, please, like, walk me through, I guess,
I can tell you a little bit about ULA if you're in. Uh,
yeah.
so I was, the names will not be named, but I was sitting with a housing provider, affordable housing provider. Really, super. I can't say enough good things about this organization. And was speaking with the party who, um, directs this, and they, I said, I don't know if you had anything to do with, ULA, but let me tell you, it was super great intention. I've got a lot of, I've got some housing providers that are in the affordable housing space and the homeless housing space, and so I go, great intention, execution though just really misses the basic foundation of supply and demand. And this person said to me, well, when we underwrote this, we just figured that the developers were making so much money that this would just, that it'd be fine. And I don't think you quite realize the fact that, like, most of these projects, they the profit margins are, kind of in the teens, if not like 10% margin. So when you take 5% off the top, you're taking between 25 on a slam dunk day to 50% of the profit margin. And this person was like, "What?" And I'm like,
Sure.
here you are in a position, like, you're the director of one of the, a very large, and they this person knows what it costs to build these things, and and they hadn't taken the time to speak with anyone in the business. If they had, they would have validated the fact that profit margins are not like 80%, like, "Oh, I sold this apartment building for $20 million, I made $15 million." Like, no.
Sure.
Nobody makes that kind of money, right? So there's a couple $1,000,000, and you take a few million off of that, and all of a sudden your margin is tiny. And I said, "Well, how did you come to that, like, realization?" And they said, "Well, we just figured they just raise the rents. If they really needed to make a profit, they would just raise the rents." And I said to them, "Okay, with all due respect, like, profit these investors are in for profit. They're not gonna leave rent on the table. Like, that's what market rent is. It's based on 100% of what you can get. They're not gonna be like, "Well, we think we can get, 35, but we're gonna put it up at, 3,000. Yeah, let's see what
Yeah.
happens." Like, no, they've squeezed it all. I mean, that's the whole nature of, if you're gonna characterize them as the blood-sucking, carnivores that they are, I'm like, that's what they're gonna do. They're gonna take all the profit. They're not gonna leave some profit for the next guy, And I said, there's just that's not what happens. And, and so at any rate, so that's how that a policy like that gets underwritten and passed. And I think that it's really quite a shame that that was super well intended, but underwritten without any, like you were saying, no seat at the table was made for the party that was gonna get affected. The tenants' rights people were there. Guess who else was there? The union was there. And
Mhm.
so the when the ULA, thing was getting, signatures were being created, again, it's super well intended. The nonprofits we got together, they had raised $100,000, and they got a meeting with the, union head, and they said, "Well, we'll give you $1,000,000, and you're gonna get this thing passed with $1,000,000. And, but when you go to build a project, you're gonna use union money." And therein lies another side of the, like, the affordability crisis is now it costs $1,000,000 to build an affordable unit because you've got, union in there. So anyways, that was a little segue, but, tell me, talk to me about ULA from your perspective as the guy who's now in the business of building these things?
I mean, there's ULA is a big kick in our balls. I mean, I don't know how else to describe it. I mean, everything that we own, that falls within the thresholds of ULA, that's one of the things I was talking about earlier. Like, you can't underwrite that, right? Like, who would have ever thought in their wildest dreams, like, all of a sudden you're gonna have to pay a transfer, your transfer tax is gonna go up 10 or 11x, right? Regardless of how much money you make, right? Like, you could lose money and it's like, oh, we lost money on the deal. Wait, no, you're not done losing money. By the way, pay 5% off the top and lose
Oh, yeah.
you got more money, right?
No.
Um,
Yep. Yeah, you buy
so
a buil yeah, buy a building for $5 million, sell it for 5.5, and you lose money.
So, that's where I've spoken to some people and when after ULA passed, like we were talking and they're like, I hate to say I told you so, but there's a reason why we're staying away from, Los Angeles, California for that matters, because why do we think things are just going to stop with a ULA type measure, right? Like, it's endless with the amount of things that you can, just conjure up as to ways to tax people, and you can't do anything, right? Because again, on its face, and again, the way ULA tax was marketed was brilliant, right? The mansion tax, like, only people who are selling $50 million mansions are going to be paying this. Like, well,
Right.
nope, that's not the way the law is written. Like, the way it's written is any transaction, right? Regardless of if it's a mom and pop, if it's some mom and pop who had an asset that they were retiring off of, right? And we're hoping,
Right.
great, like losing out on 5% of their money is meaningful, right? And
Yep.
like, yeah, so
Yep.
so again, like, you take a situation like ULA, it's they're look, what I could tell you fundamentally, what is it doing? It's driving up the cost of everything, right? Because if I know I'm going to lose 5% on the back end, well, that just means like either I have to pay less to the seller or I need to charge more rents to make up for that 5% that I'm losing.
Right. And there's a fair number of investors, I mean, on the brokerage side, where they just say, "Look, I I wanted to sell this thing. I'm tired of owning it, but I'm just gonna let it kinda rot because I can't bear the idea of writing a giant check." So, all of that, you know, whatever you were gonna do to that building, fixing it up, cleaning up the facade, which I would say has a huge social impact, like improving the city's, look and feel and so on and so forth, for whether you're moving into the unit or on the outside, or all that stuff, has dropped by 80% on transactions that are over $5 million. So all those apartment buildings that are worth more than $5 million, their transaction volume has dropped by almost 80% because of that.
Wow.
It's just like
Yeah.
everyone's like, "I'm stuck," you know?
Look, it's simple, right? Like, we as developers, business people across the board, I don't care if it's in the real estate industry, in any industry,
Right.
right? You just look at the incentive, right? Look at the incentive, and that will dictate how we behave, period. It's not any more complicated than that. You create bad incentives, you're not going to have anything. You create good incentives, you're going to have stuff. It's like when they took away or they reduced the film tax credits, the state started like, what happened? Production started moving out of California, and
Bye-bye.
it like it doesn't take a genius to figure out why. It's pretty straightforward. Like, at the end of the day, right? Like, as a business person, you kind of follow, okay, where's the best opportunity to make money? And it doesn't need to get any more complicated than that. Of course, there's other maybe byproducts of what we're doing, in particular housing, right? Yeah, creating housing, creating good solid housing for the community, like, it does feel good, right? Like, it is
Right.
nice, like, we make it a point, we want to engage with our tenants on every level beyond just providing them housing. We do events, we are proactive in reaching out to them, asking, like, is there something you'd like to see, right? Like, let us see if we could do that for you. Now, obviously, we have our own incentive to want to do that beyond just being nice, and that's if we could reduce turnover. Great, it's like we want to keep them there, but that's a good incentive.
But that's a
Why?
that's how
Because the tenants
how the world
getting out of it. They get, they're getting more for the building. They're getting more in their unit. We're doing improvements, and in return, we're getting a tenant that is making sure to pay us rent. That's not leaving. That's keeping the right. If they respect their unit, they're going to keep it in good condition. And now you've got a very symbiotic situation going on that ultimately, right, is driven by the incentive of the situation.
right. Right.
Right. And so, to simply tell, a landlord, will do something for the sake of doing good. It's like, yes, I wish I didn't have to worry about a return, or go to the banks and tell the banks, give us 0% loans. Give us a 0% loan, and I can assure you, I can start, shifting returns or profits back to the buildings in exchange, which like, again, there is some element of that where we're doing grants and other things like that, but that's not sustainable, nor is it scalable.
No. No.
So anyway, it's something I'm passionate about in terms of just, again, we as a housing provider, like, I want my tenants to be happy. I want them to be happy to come home to where, to come back to their homes. I want them to be proud of where they live,
Right.
right? Like that is 100% um an element
Yep.
of decisions that we make. But ultimately,
Right.
yeah, we want the tenants to be happy, right? If your tenants are happy, like, there are numerous, there's numerous benefits you get from that when you have a happy tenant,
Right.
right? So, like, it's there, but when you start creating a more combative environment, um, and you start hamstringing how you go about making money, it becomes a very, it's just, it's like playing five-dimensional chess when you buy a property of, like, okay, how do I navigate every aspect from regulations to construction costs, um you know to what's happening in the capital markets, and you're having to piece all of this together. um it becomes, just that much more difficult when you feel like there's just landmines all over the place from, from a regulatory perspective that can literally just blow up a deal. I mean,
Right. And blow up
not
your windows and whatnot.
we're not collecting rent. I mean, forget returns. Like, it's one thing to make less money. I'm talking about just losing your deal completely. Right? Which, like, it's happening a lot when you can't collect. Like, I knew a lot of owners that were just trying to sell because, you looked at their AR reports, basically like their bad debt, and,
Mhm.
they weren't collecting 80% of their, 80% of the income. It's like, how the hell do you
Oh
make
my
sense out
gosh.
of it? Right?
Yeah,
So, I
you
mean,
can't
just
do that.
real wild horror stories. So, no, you can't. But look, like, overarching is, like, you should be having your tenants in mind when, as you make decisions, even if you don't care about their well-being, which you should. But even if you don't, caring about their well-being ha, has a dollar value to it, right? And, like, we see, like, the more we invest back into our buildings now where we can see a return, like, tenants, for the most, I mean, obviously, within reason, tenants for the most part are okay to pay some amount more, right?
Right.
In exchange to know we are going to get something. We'll have a better building, it'll be cleaner, we'll have more security, you name it, right?
Right.
So it's there, but I just, I think a lot of times we can lose sight of we lose sight of it and just kind of think very one dimensionally, like, oh, landlords just raise rents, screws over tenants, we can't allow that.
So I got a question for you. Um, I got one comment and then one question, and we'll wrap up soon here. So one of the things that I've noticed about the regulatory environment is the harder the city crunches down on the landlord community, the more my mom and pop community of investors has retired and gone away, essentially making the management of a building harder reduces the incentive part in an oversized fashion. It makes it harder for a mom and pop to do business. A bigger family office can hire management, they can do
Sure.
more. But when you're just sort of out there on your own and you got one or two buildings and you're trying to just make, you're trying to build some sort of like nest egg for yourself in retirement, it's very hard because all of a sudden you have to do so much more work. And I've seen those parties basically exit the business. And having said that, the question for you is that it definitely feels like there are less investors in Los Angeles today as a result of all this. Would you basically agree with me?
Um, I, I don't know about there being less investors. Let's just say there's less people buying. I still think
Yeah. Okay. So fair enough. And so that they're all here, the money is here, but they're scrutinizing deals much more harshly, and the transactional
yeah.
volume is way, way down. Okay, so I've got one more statistic for you. So I did this big study related to markets, and it was almost stupid how balanced the market cycle was. It was basically, I think it was 11-year cycle, or is it nine or 11? It wasn't 10, but it was 1 year off of that, and I'll have to double check it now. Essentially, the market cycle was following this pattern for the last 30 years. We are now several years into a down cycle, which is suggesting that we're now at our trough, right? Our peak was 16, right? We're at
Mm.
2025. 20, what, around 20 was where everything kind of just crested and went bye-bye. So should the investor today, particularly, I'm going to, target this to that mom and pop, that younger investor, right? Guys like you and me, maybe more you than me. Um, Younger investors that are looking at the marketplace, have some money, looking to invest, that mom and pop investor, should they be entering today? If they've got the wherewithal to fight through some of this stuff that we've been complaining about the last 30 minutes, is now a good time to buy real estate in Los Angeles. We got investors are tired of seeing it all. Cap rates have gone way up, that those deals that you said no to, those are 6.5 caps. I'm closing those deals at.
Mm. Scott, you there?
Should people, yeah, I'm here. Should people be buying today? Is this the opportunity that we're in right now?
Um, it feels like we're maybe going to be turning a corner. I think there's a lot of anticipation with like we'll see what happens with rates. Um,
Yeah.
are we speaking more specifically to Los Angeles or just broadly to real estate?
Let's speak about Los Angeles right now, because I think that's
Yeah.
sort of that's our backyard right now.
Yeah, I think. Look, I'll say it like this, right? I think in terms of what it is that you are trying to achieve, right? And like kind of what your thresholds are for returns. Like Los Angeles to be buying today can make sense. I mean, we're building right now, right? And
Okay.
we're you know, hopefully going to hit yields that I think will look very attractive. Um and we have this we're taking a much longer term view on these deals than what, let's say, we normally would. So in that scenario, it's like, look, I think if you take a 20-year view of LA, right, like you'll win, right? I think it's like you look at you'll make money there, right? So long as you take out the spot, you're not over levered or something along those lines. But like you'll do fine. Like if your goal is to try and buy and flip out of deals quickly, right? Which is what has been kind of what's kind of um been like how a lot of, you know, we included how we've looked at deals over the last decade or so. I think that's going to be incredibly difficult,
Right.
right? I don't think that that's there. So, you know, does that mean you start buying today? That I think it's a very much more personal question as to like what you're trying to accomplish, because yeah, it is more nuanced. Like back in 2013, if people came to me and said, "Should I buy?" or 2014, it's like, yeah, go buy, right? Like it's a no-brainer. You're gonna go borrow at 3% and you're buying a 7 cap and you're gonna take 15% return on your money. Like that, you know, that's not a hard thing to like kind of wrap your head around. Um,
Mm-hmm.
but you know, you have questions about how much rates are gonna go down, you know, how many, you know, where do interest rates settle at? Um, you know, there's just a lot happening on the regulatory front, for good and bad, right? Like I 100% can say that we are trying to do things to spur development. You know, I'm hopeful in general that like our city is gonna want to continue to, or just take more of like a pro business stance over the years, for in the years to come, just by virtue of kind of just been, I want to say, like California has some of the highest unemployment rate. Um, I don't know about Los Angeles specifically, but you know, like I can say, you know, confidently, like I know the a number of our councilmen, they're trying to do things to spur growth here and promote housing development. Um,
Right.
and again, I think as a Los Angelino, ultimately, like Los Angeles is like one of the top cities in the world, right? And you know, sure you can, maybe there's some better cities out there, but for that simple reason alone, like we still are going to attract people, maybe not as much as what we used to, and probably a lot of that has to do with the fact that it's so damn expensive. Um, but you know, from that perspective, like yeah, I think over the long run, which you know, put a time frame on that, 10 years, 15, 20, like
20. Yeah.
this will always be an attractive place to park your money. Um, you know,
So
yeah,
here's I got to have a question for you. So at the beginning of that last market cycle, it was, you know, rent growth was really one of the things that drove this. We've had a lot of rent growth, and it I do remember when I first moved to this town that, you know, rents were, you know, $1,200 for a one bedroom, and I had just moved in from San Francisco, and I was like, "My god, that's like it was like 1,800 $1,800
sure.
for a one bedroom." And so
Sure.
it was actually that outsider, it was that outsider perspective that, for me, talking with the guys that were there head in, they were like, "You're crazy, Scott." And I said, "You know, this city is undervalued." So I suppose the big question is are we are we going to look back on 2025 and 2035, and we're going to be talking about how a $2,000 a month apartment for a one bedroom, man, had we had known that it was going to be $4,000 a month in 2025, 2035, is that going to be our conversation? Because I mean, candidly, if you dial back the 2008 marketplace, pre crash, and you look at what was happening on the run up to that, it was everything was halfway there too. And there was always this, like, the rose is always the, you know, the past is always the rosy, easy place to make the money, and the lack of clairvoyance looking forward is always where the risk is.
Look, I mean, yes, I'm sure on some level, right? Like real estate typically is considered a good inflation hedge, right? It's just things get more expensive and all that. Like it'll raise values, you get increased rents and all of that. Are things going to go from 2,000 to 4,000? Who knows? But also, I think it matters like what are we looking at, right? Because like if you own a rent controlled building, that 4,000 may mean nothing to you because you know your tenant is never going anywhere, right? And like that's kind of the bigger issue here is like when you're buying rent control, it's like sure, I mean you don't necessarily need it to go to 4,000 because you know that the tenants, let's say, only paying 1,000 today, and there is an opportunity to mark up rents 100%, but you're never going to get there because your tenant is locked in at their rent. Um,
Mm.
right. So from that perspective, it's it's like almost a moot point to think about, well, where are rents going? And that, for us, we're largely looking at just in place caps again
Right.
because, buying rent control, there's too much of a crapshoot as to um when you could reasonably go, you know, get your unit back and go start charging market rents. Um, on the development side, it's unbelievably it's very hard to make anything pencil, right?
Right.
And you don't have 10 years to go for rents to double, for your investment, before your investment would need to be turning a profit. So,
Yeah. Yeah.
it
You got to
and
track.
and it's look, it's near impossible to predict 10 years out, right? Like, you can't predict 10 years out. Anybody who it's like, yeah, we'll throw an exit cap on a 10-year model, but it's like, that's just you might as well pick any number.
Are you? It sounds like you're accusing me of being a real estate broker all of a sudden. I'm like, I'm selling the future. Yeah.
Look, I am a firm believer. Look, we're still investing in Los Angeles, right? Just not nearly at the same rate or volume that we once were. Um,
Right.
is this just the way like cycles? Is this the way cycles go? I'm sure it is, and this is time will tell if this is going to be the right buying time or not. Um, but yeah, look, to that end of, someone's got money, do they invest it in LA? I'm going to give you a really cop out answer, and I'm just going to say it depends. Um, but
Depends
if
on
they
the
have
deal.
money and they want to give it to us to invest,
There you go. All right. Well said. All right. When you're not doing this, we'll close up on this stuff. When you're not taking calls from me or my competitors or whatnot and looking at deals, what do you how do you spend your time?
sorry, you cut out badly there. You said when I'm not
When you're
doing
not
this,
Yeah, when you're not doing
about
real estate stuff. Yeah, when you're not complaining to brokers about pricing and our horrible underwriting, how do you spend your time?
just sitting in a corner of my room groveling about the real estate
Yeah.
industry.
That's all you do.
That- I lock myself in the closet and just cry.
There you
Right.
go.
No, so yeah, I've been playing tennis my whole life. Tennis is still a big thing. Playing tennis tournaments, playing with buddies. Um, Piano is also one of I was a major in music.
Oh, I
So
didn't know that. You majored in music?
yep.
I'm gonna
My parents didn't know that either until after I graduated. So I studied business and music.
Okay.
But when I told them, my end of sophomore year, you had to declare your major.
Yeah.
And I told them like, mom, dad, so, like, be proud of me. I'm gonna be, I want to study music. They're like, cool, we're pulling you out of school.
Yeah, cool. Good.
Like we are not paying this kind of money for you to go slap the piano around a little bit.
Where'd you go to
So,
school?
Michigan, University of Michigan.
Okay. All right.
Well, I wound up, I applied to the business school. Fortunately, I got in. But the way the business school was set up was they were extremely supportive of um, us taking other subjects, right?
Right.
Of taking extracurricular classes. And because I had taken so many music courses my freshman and sophomore year, I was able to still get enough credits um, to get a major in music. So I continued to study music while studying business. Anyway, at some dinner event, like a year or two after I graduated, I was sitting down and someone asked me, what did you study? And I would always tell people I studied music. My parents are like, they looked at me and they're like, what do you mean? because I only invited them to my business graduation. I didn't invite them to my
Right.
music graduation. Um, so, so they were looking at me like,
Everyone
why
was
are you
high at that one.
laughing? Yeah. And I was like, no, I studied music. I'm like, I did study music. Like, you studied business.
Yeah.
Yeah, I studied that too, but music is the one like I'm proud of. So just like, why would you lie about this? I'm like, because if I didn't do well in school, I just figured you would have pulled me out and complained the fact that I'm studying music.
Right.
And so I just, kind of kept it on the sideline.
That is how.
Anyways,
What kind of
music is a
music
big thing.
what kind of music is like that, what speaks to you?
I
What's
mean, now, I mean, it ranges from
what was it
kind of.
I want to know then.
So, my like the concentration within music was composition, so writing
Okay.
and piano performance. And I mostly at the time, was more classically influenced, but also
Okay.
loved jazz. So, the music I would write would kind of be some sort of mix of classical and jazz. It sounds way more impressive than what I actually produced, but jazz and classical are kind of the preferred genres. With to my wife's dismay, because I really don't listen to music past like 1950, and so
Nice.
I'm like that grumpy old man. Every time she puts on the radio, I'm like, oh, you kids in your music, this is
Yeah.
crap. I swear, just sitting there. It's like if I'm not complaining about real estate, I'm complaining about the industry now. On the music scene.
My daughters put on some this like young country like guy who's like 15 years old, whatever, and we're listening to it, and I'm like, okay, this is all good except for the fact that it's horrible. So we're gonna I made them listen to Led Zeppelin. I was like, so you have to understand that rock and roll, this guy's like doing this version of rock and roll, but it's so just washed out. Like you have to understand what the foundation is. So I'm putting on Black
Yes.
Dog and Stairway to Heaven. I'm and they're like, what how late do we have to do this? My daughter actually, Poppy, she's composing on piano right now. So I've got a budding musician in the family.
Oh,
And
that's
the other
awesome.
two are doing something else, but yeah,
There we go.
she's doing
There we
something else.
go.
Yeah. I had no idea, Daniel, that you had that art bone in you. There's a reason I like
Oh yeah, I was in a band. And when I was in Israel, I was
Nice.
also in a band.
What
Like,
kind of music was in the band?
I mean, we were a cover band of like The Doors, Led Zeppelin, and stuff like that.
Uh-huh.
I can, again, sounds way more impressive than what we actually were. I think like maybe we only got booked one time to like perform at a club and never got out of it. Uh, but but we had fun doing it.
Yeah.
Um, and so yeah, like now, my wife can't. And my wife is extremely patient with me, but with our 20-month-old that we have, I'll sit and play the piano and my wife will just be like, what the hell? Like, you got to stop practicing, And I'm like, I'm doing it for the kid. So now at least like with our daughter, I'm like, this is good for her to see, discipline, commitment to something, it's a good excuse for me to be able to play. But no, that's like my lifelong dream, right? Outside of buying real estate in LA or real estate in LA is to go open up a music school, right? Like if I could go open up a music academy, like that's my goal in life. And like I would love to go back to Rio and just dedicate my life to music and have real estate become my hobby as what piano is what music is
Right.
to me today. So hopefully, God willing, I'll get a point where I can kind of just make that the primary focus of mine. And then also I'm a really lousy chess player.
Okay.
That um that's something which takes up way too much time of mine.
Really?
Uh oh my God, like it's bad. It's almost when I'm playing chess, my wife will come over and you would think I'm looking at like, you know, pornography or something.
Right, right.
And like I have to wipe out of the app. Like he's like, "What are you doing?" I'm like, "Oh, nothing, I'm just looking up. I'm just looking at a website." But
Just looking at it on website.
I'll
Yeah.
I mean, I woke her up like a couple weeks ago. I'm playing, you play against online, you play against people, and I'm a quite competitive person. And I woke her up
Doubt it.
because
Picked up.
I lost a match to a guy that I was lost a chess match that I was crushing him, and I made a horrible move, and I wound up losing, and I yelled so loud, and we were in bed. This was like 5 in the morning. She's asleep. I'm just playing, and I woke her up, and she thought like I yelled so loudly, she thought someone broke into the house, and like she like looks at me, she's like, "What? Who's here?" And I'm just like, freaking some guy from like, Afghanistan just beat me. She's like, wait, what? She's like, beat you? I'm like, yes. I just lost in a chess match. And she, I think, was ready to just punch me in my face.
Yeah.
But
Yeah, that's it.
anyway, that's kind of an
That's
indication
hilarious.
of yeah, the things I enjoy doing. But yeah, I'd say tennis, chess, and piano are kind of the go-to things right now for me in my time.
That's really neat. That's wonderful to learn about and hear about. All right. Well, listen, man. I promise to get you out of here by 11 o'clock, and it's 11:15. So, it's great learning a little bit more about where you're at, and I think your insights. It was wonderful to kind of hear some of your insights about the investment world. And we'll do some follow up on this, and it's great talking with you, man.